Alright, so where I asked you to leave off in the previous video was to think about the tax consequences of what happens when you get a payout from a pension fund. Now, you can expect that if you've been saving up for 40 years, the amount that will be in that fund when you retire is going to be quite large. And if you were to take a third of it in cash, that's a big amount. Let's just say it could be in the millions. Now, if that amount is going to go into your gross income, we need to start to think about the tax consequences. And if you're going to have a big amount going in, let's just say $1,000,000, that's going to push you up into a much bigger tax bracket than you normally would have been in. And I don't think the intention here is to put a massive amount of tax onto something that you've been saving for your whole life, but now you're going to be taxed at this high rate just because you're getting it all in 1 year. At the same time, you should also be thinking about these annuities that you get monthly from when you retire. They're going to have to go into gross income, and the most obvious reason is just because, hey, it's in the form of an annuity, so it has to go in anyway. So what we can see here is that all these payouts from the pension fund, provident fund, or RAF are going to go into gross income. But we do need to now think about the fact that they're going to be taxed in a certain way, because just sticking them into gross income and doing the tables is going to be quite prejudicial to you. It's going to mean that you're going to get taxed a whole lot, and up to 45% of everything that you've saved, and that doesn't seem like what the government is trying to achieve. The last little, let me just go back here, term that we need to think about is the minimum individual reserve. What that is basically meaning is just how much you have in your fund at a certain point in time. Okay, so all that's saying is just how much you have in a fund at any given point in time. Okay. Great, so how does this all fit together? What we've been speaking about needs to be put into context, and here's the stuff you need to remember. Section 11F is your deduction from taxable income for the contributions that you or the contributions that your employer has made, which are counted as a fringe benefit, to any kind of fund. So Section 11F you've done before under natural persons when doing tax. That is the deduction where you add them all together, you apply the 3 different types of limits, and you claim a deduction from taxable income for Section 11F. Gross income, found in Section 1, then defines what has to go into gross income in the first place. That is your normal, any amount received by, accrued to, all those kind of things. And remember, the special inclusions afterwards says anything in the form of an annuity as well. Okay. Next, a severance benefit. It's a type of payment that goes into gross income, but is taxed differently. It's taxed as a retirement benefit if it meets certain requirements. We're going to look at what those requirements are now. The second schedule, that is something that deals with payouts and certain annuities from retirement funding when you retire or if you withdraw from the fund before retirement. The second schedule doesn't deal with the contributions directly. The contributions are in terms of Section 11F at the top. The second schedule deals with the lump sum payouts that you get from a fund when you retire or withdraw from it. Lastly, Section 10C, that's a specific section we're going to look at later that deals with unused Section 11F deductions. So let's dive in. The first place we're going to look at is retirement benefits, and it's the big picture. We're going to look at severance benefits. Okay. The first place we're going to look at is paragraph D1. Okay, paragraph F as well, but we're going to focus only on D1. Now, what D1 speaks about, remember, that's going to be a special inclusion of the gross income definition, something that comes after the general. And what it says is the following. We hear any amount, okay, including any voluntary award received or accrued, and this is in respect of relinquishment, meaning give away, termination, loss, repudiation, cancellation, or variation of any office or employment or of any appointment to any office or employment. What this means, if you receive any amount in respect of stopping, changing, canceling a contract, varying your job, okay, that amount is going to go into gross income. So a severance benefit, what we're generally thinking about here is when your job is stopped, or when you stopped working and you get some kind of payout, what happens to that payout? Well, this paragraph in gross income says, well, that amount has to, as a first step, go into gross income. Okay, so it's got to go in. The gross amount of any lump sum is included in gross income, and if there was nothing about fringe severance benefits, it's going to be taxed like normal. But there are some requirements that will make it a severance benefit. And if it is a severance benefit, it's going to be taxed in a certain way. All right. And here are the requirements for it to be a severance benefit. You must meet one of the following. So it must be in terms of paragraph D1. It must be received by the employee, and you must meet one of the following three. You must have attained the age of at least 55 years. You have to be at least 55 years old. Or, remember this is an or, you have become permanently incapable of holding your office or employment due to sickness, accident, injury, or incapacity through infirmity of the mind or body. Basically, in some way you've become disabled, and the key word here is permanently disabled. So this is not I broke a leg and I can't work for a few months. This is I'm unable to work in this job for the future. I can't ever do it again. So you must either be above 55, permanently incapable of holding that job, or your employer has ceased to carry on or is going to cease to carry on trading. Okay, so your employer shuts down and you get a payment, or they've made some kind of general reduction in staff or personnel, and you've been made redundant. The key thing this is generally called is a retrenchment. So if there is a retrenchment package in the business, so they're needing to cut down on staff and they give you some kind of a payout, that will count as a severance benefit. Now, if you get any lump sums, okay, due to changing job, stopping job, and you meet one of these three, it's going to be counted as a severance benefit, and that means it's going to be taxed in a certain way. The way it's going to be taxed, it's going to be taxed as a retirement lump sum benefit. Okay, what this means is it's going to be taxed on a different table. So it's still technically going to go into gross income. I'm going to make this bigger here because it's quite important that you get this distinction. If something is a severance benefit, it goes into gross income. It's there, it's part of gross income. But what's different is that it's going to be taxed according to a separate table. So what you have to do is when you get to the end, you have to take it out of your total. You have to take what's left of that total, tax it as per the normal progressive tax tables, and the portion that is a severance benefit, you have to tax according to a separate table, and then you can add those two taxes together. Okay, we're going to look at what that separate table is in a little bit, but you need to know that process. Now, the textbook has a good example of how you can do this. You can either add everything up in one column. When you get to the end, you have to remember to take off anything that's going to be taxed in a separate table, or if you want to, you can use two columns and just say, well, hey, this column is going to be subject to this table. This column, that's very weird because it's mirrored the screen. So when I go left, it actually goes right. This column is going to be subject to the different table. But you do have to indicate to the marker that you know all of it is going into gross income and that it will be taxed on different tables. Okay. So that is severance benefits. This is just a summation of what I just said. Okay. The second thing that we need to think about here is benefits that happen when you actually leave a fund. Okay, I'm just going to move this slightly so that I'm in the white portion of the screen. What this is about is when you actually retire from a fund and you get some kind of a lump sum payment. Lump sum means a once off in a big go. So this is going to be the 1/3 of a pension fund, the 1/3 of an RAF, or whatever portion of a provident fund you wish to take as a lump sum. Okay. What happens is the second schedule groups lump sums from retirement funds based on what type of event led to you getting that lump sum. Okay. It can either be due to retirement or it can be due to something that happens before retirement. How I'm going to summarize these, just remember you can't use these words in a test or an exam. If you retire or if you leave the fund due to retirement, I'm going to call that the good way of leaving. It's leaving because you reached a certain age. All right, so it's the good way. The bad way, when you leave for some other type of reason. So you leave the fund because your employment has changed or you get out the fund for some other reason. I'm going to call that the bad way of doing it. Okay, remember this is informal, but just a good way for us to remember. The key thing, both are going to be included, where's my mouse, there you go, in gross income, because there's a special inclusion, paragraph E. Paragraph E is going to bring in any lump sum payments from any of these funds. Okay. Now, it goes into gross income, but once again, we're going to use a different table to tax. And the thing here is that there are two tables, depending on the reason for you getting this lump sum. We are going to have what is known as the good table, and we're going to have what is known as the bad table. Their real names, just your retirement lump sum benefit table and your retirement lump sum withdrawal benefit table. The good one, the bad one. The good one happens when you retire and you get a payout because of retirement, are you due to age or death or permanent incapacity. Okay, you'll see in most of the videos we've recorded, it in some way deals with death, and it's an unfortunate reality that tax is always going to be something that deals with death. You know that saying, there's two things in life that are inevitable, death and taxes, but also when you die there are lots of taxes as well. So this is known as the good table. The bad table is what happens when you leave the fund for some other reason. So if you get divorced, or if you resign or get fired or leave your work and you have to get out of the fund for some other reason and you get money, then that is going to be on the bad table. And the difference is you're going to in effect be taxed a bit more on this table than this table. Okay. Cool. Now, what we need to think about when we get a payout from a retirement fund, only the taxable portion of that is included in gross income. So what this means is that any lump sum you get is going to be the gross amount of the lump sum less allowable deductions. Okay, so allowable deductions are taken off of the gross and only the net is put into gross income and taxed as per the table. Paragraphs 5 and 6 of the second schedule list what allowable deductions there are. So what type of transactions would qualify as deductions? Okay, I want you to pause the video here whenever you're watching it, go and read paragraphs 5 and 6 and find out what these deductions are. Okay, so pause here, go look, see what they are. Great. Now that you've resumed the video, what you will see is that these deductions exist when you transfer from one fund to another fund. So you're very much allowed to take your money from one pension fund and put it into the other. When you do that, you're going to withdraw, you're going to have this gross amount that accrues, but then because it's going to another fund, it is allowed as a deduction, and in the net there's going to be 0. Okay, so what you need to take into account here is what are the allowable deductions, okay? When are they allowed? And what it's going to do is it's going to take whatever payout you get, if it's going into another fund that's on that list, it's going to make the gross amount 0 and you're not going to get taxed on it. Okay, where we're going to go next is we are going to look at and examine the two different tables and how we actually use them. Okay.